Hello, everyone. Today on the final bar, we'll do our normal Friday routine, which is to wrap the week. We'll focus on how the picture has changed from last Friday to this Friday. And I tell you what, it has changed quite a bit from Friday's sell-off going into Monday's distribution, and then the V bottom off the 50-day moving average Tuesday through Friday, accelerating to new highs with the S&P above 4,400 for the first time. We'll look at all of the charts that tell that story. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the evolution of the markets day to day. We focus on how the charts are changing, what's working, what's not, what's leading, what's lagging, what's going up, what's going down, and the message that price really provides. As my mentors taught me early on, and as I remind you often on the show, when in doubt, follow the trends, follow the price. If you want to understand what's happening with the S&P 500, start with the chart of the S&P 500. Just the movement, the day-to-day movement, how that fits into the trend over time and how the price evolves tells you a lot about the overall conditions. When we think about the S&P 500 this week, weakening Monday, and Monday at the close, it felt like, boy, we could go dramatically lower. And look at how the 50-day moving average held once again, as it has many, many times so far year to date. We're going to look at all of those charts as we wrap the week and focus on the Mindful Investor Live ChartList. So a lot of great content to review for you. We had some wonderful guests this week. Had a lot of fun talking with guys like Ari Wald and Jonathan Krinsky and Dale Pinker, three fantastic guests with some really good thoughts on the overall environment. Next week, some fantastic guests as well. On Tuesday, the 27th, Mary Ellen McGonigal from MEM Investments. On Wednesday, July 28th, we have Cliff Droke from the Cabot Wealth Network. On Thursday, July 29th, technical analyst Bruce Powers joining us. Also, as a reminder, next Tuesday, the 27th, is our next episode of The Pitch. The Pitch is our monthly discussion where we bring three expert strategists together to focus on their 5 picks and what they're seeing, where they think you should be looking, and then we'll discuss them as a group. It's a lot of fun, and you will leave that event with a list of tickers to review and think about on your own. For more info on that great discussion that I'll be moderating on Tuesday, go to stockcharts.com/thepitch. Let's continue on with our Wrap the Week segment. We're going to start with a poll. We often have a poll running on our Stock Charts TV page, right on the Stock Charts website. Also on social media, we'll throw a couple polls out every week. Would love for if you would respond to that, and hopefully it helps nudge your own thinking in terms of where you're looking. This most recent poll was, which asset class do you think will perform the best over the next 3 months? And I gave you 3 choices: gold, bonds, or the S&P 500 stock. So basically, paper, rocks, or scissors is the way we usually think of this. So gold, 22%, bonds, 21%, which means 57% of you said stocks. And it's interesting looking at those 3 charts and getting to the S&P 500 here momentarily. It's hard to argue against the uptrend in stocks, and it's always interesting to see what's happening as we're asking this poll. We opened that poll on Tuesday, so from Tuesday through today, it's been a pretty strong bounce higher, pretty sudden move upwards as gold and bonds have taken a bit of a breather. The S&P 500 has moved higher. We'll talk briefly about bonds. We'll probably talk about this a little bit more on Monday's show, and we talk a little bit more about the macro environment. But the chart of the TLT is an interesting one. And if you know your candle patterns, it might be a little hard to see this. Let's go to a 3-month chart, and we'll go candles. Here we go. Does anyone know what this candle pattern is that I'm highlighting? It happened on Monday and Tuesday of this week. The correct answer is the dreaded bearish engulfing pattern. This is where you have an up candle with the close above the open. The next day gaps higher on the open, but closes below the first day's open. And so it's basically the day 2 open to close range engulfs day one. That's why it's called a bearish engulfing pattern. This is a classic candle reversal signal, indicates the exhaustion of a short-term uptrend, and the next couple bars should be lower. So that signal that you saw on the TLT suggested that bonds had rallied a little too quickly. Expect a bit of a short-term bounce to the downside. You can see the momentum was actually a little bit lower, so you have a little bit of a bearish divergence there going into the high at the beginning of this week. So certainly indicating a potential for bonds to come off a bit. They have. The question, though, is what's next? And I think if I had to answer this question, which I did not, over the next 3 months, because of that time frame, I would probably say stocks, only because the base case I've had for the whole year has been a repeat of 2010 in some form, which is a choppy period with some drawdowns, but overall finishing the year stronger. And I don't see bonds or gold as being able to overtake the run I think stocks are most likely to have. What I have been expecting is a little more of a pullback before that resilient rally to the upside, but that's not what we've really seen. Every pullback that we've started to have has really not materialized into anything more significant. In this week's brief pullback into the Monday low before resolving to the upside, I think two things that does. Number one, it reinforces the importance of the 50-day moving average. And if you've not understood or respected the 50-day moving average and how that has served as an important support level, hopefully now you've seen that. Just in the last 2 months, we've now had a couple pullbacks, same as we did in May and in March and in January. Every one of those times, February as well, we keep bouncing off of the 50-day. So number one, it reinforces the importance of that as the line in the sand to pay attention to. The second thing, what it suggests to me is the more times you bounce off a level like that, if and when we eventually break below the 50-day moving average, which I guarantee at some point we will break below the 50-day moving average at some point. It may not happen today, but at some point we will do it. And when we do, the challenge is when people have been expecting support there for so long, when it finally does not hold, and when people start to recognize and realize that that is no longer a valid support level, that's when things can get very ugly very quickly. When there's broad distribution, when people recognize that the picture has now changed, things are a little different. We're no longer in the environment where the 50-day is just a buyable dip indicator, and all of a sudden it's a signal of a break in something further. So I thought potentially this week was going to be the time when we had that break. We have not seen it yet, which I think is just setting us up for another rally, which we are now in the midst of, and setting us up for at some point a rollover and a break of that 50-day. I think is becoming more and more of a negative sign when it actually finally happens. Now let's wrap this week very quickly. We're going to look at today's trading just briefly, then we'll focus on the week and how that played out, and then we'll finish off looking at the Mindful Investor Live ChartList. Today was about communication services leading to the upside, and look at charts like Facebook. I was chatting with Larry Tentarelli, who's on the show recently, talked about this stock not too bad in terms of its return. Again, pulling back to the 50-day as the market did, rotating to the upside, up over 5%, just narrowly, missing the overbought region, but making a new 3-month, 6-month actually relative high. Nice, move to the upside. And again, charts like that being strong, charts like Microsoft continuing to make new all-time highs. The market cannot be too bad when stocks like this are moving to new highs. There can be choppiness, there can be areas of potential relative weakness, but overall the trend remains very strong. And I think that's what we're seeing. Interesting on a day like today, where we're making new all-time highs. Sector number 2, utilities, which is actually very defensive. Sector number 3, also very defensive, consumer staples. So on a day like this, when we're bouncing higher, consumer staples outperforming consumer discretionary, which is an interesting one. At the bottom, the cyclicals, which have had a place of honor at the lower end of the sector summary table for quite some time now. Energy, the only one of the 11 S&P sectors down today. All the other ones were in the positive. The S&P up about 1%, mid and small caps lagging behind, and the VIX back around 1725. Interest rates bouncing back higher today with the TLT, as we mentioned, going down about 0.2%. The dollar index essentially flat, remaining around 25. Gold, precious metals down today, while the rest of the commodity complex actually, pretty much mixed, to be honest with you. But as I mentioned, energy prices a little bit lower. Cryptocurrencies have rallied very nicely, but have now stalled out a little bit. Everything but Bitcoin and Ethereum down today. Those first two were sort of flat for the day, chopping around quite a bit, remaining above that 32,000 level for Bitcoin. Let's look at how the week actually played out. And this is a chart using sort of the basic asset allocation ETFs that I tend to look at, is with Bitcoin in there as well. I'll walk through very quickly what these different lines indicate. And you can see we're starting the clock, the last Friday's close, and looking to where we're at right now. The S&P 500 finished the week up just under 2%, rounding up to 2%. So a nice strong move to the upside overall. And again, that's with Monday into Tuesday jumping, or Monday really, Friday into Monday going lower. All of that taken back and more, with the S&P up 2%. What underperformed the S&P this week? The crude oil using the USO is here up 0.7%. Right along the same lines, we had the dollar index and also bonds up 0.2% for the week. Two things were down on the week. Gold was actually down 0.5% using the GLD, and the laggard of the week was the emerging markets index, EEM, which was down 2%. That, if you look at the relative strength of EFA versus EM, right, which is developed versus emerging markets, very much favoring developed markets right now. What outperformed the S&P? Just a little bit more than the S&P were small caps, which actually up 2%, which is just an interesting one. You may not have expected that given the strength that you've seen today, especially stocks like Facebook and others. But remember, midweek, you had that bounce higher with small caps actually raging and outperforming midweek. That sort of tapered off yesterday, but overall still enough to outperform the S&P. The strongest with two asset classes, or how I describe them, the NASDAQ 100 was the best, just under 3%, right about that same amount, about 2.9%. The price of Bitcoin, which was up there. So overall, a healthy week for stocks by the end, Friday to Friday. And again, that was coming off of a weaker move Friday, the lower move into Monday, and then recovering very nicely. Let's continue off, finish the Wrap the Week segment, looking at the Mindful Investor Live ChartList. As a reminder, you can access this at any point by going to the articles tab at the top of StockCharts. Go to my blog, which is called The Mindful Investor. And at the very top, you'll see a gray button for live chart list that'll take you right to this page. We'll start with the market trend model. We review this every Friday. Let me just refresh the chart to make sure it is updated, which it is. My medium-term model has been negative since May. It still remains just right below the zero level. It has resisted this upward pull of stocks and gone higher. And it's interesting. What I generally think of that as my risk on versus risk off meter. It does not tell me when that turns negative to sell everything indiscriminately. Just like if things are going down and it rolls higher, it doesn't tell me to just randomly buy anything I can see. It tells me whether to think more risk on or risk off, think more about potential reward or more about potential risk. It does not tell me to stay away from trends which are working. So charts like Microsoft and others that are in good uptrends that continue to work, I don't see a reason why you would want to get away from those until the charts themselves tell you to do it. When this model turns negative, which it has been since May, it tells me to think about lines in the sand, which has been very helpful on things like gaming stocks and airlines and energy stocks and financials, which had been in good phases and have all rolled over to the downside. At some point, if we continue higher, I would assume that this would rotate back to the upside. What it tells you is just the momentum has not been super strong in these last couple of weeks, enough to push this model back to the upside. The short-term model has remained essentially bullish for months and months, given the short-term strength, how Friday tends to finish pretty strong for the S&P 500. The daily chart of the S&P we talked about briefly, and again, I think bouncing off the 50-day is the story. As we sold off to the 50-day, as we reminded you on Monday, this is a level that has proven as support many times. I would assume that serves as support until proven otherwise. It has not been proven otherwise just yet. The S&P is moving higher. I was asked, is this a bearish divergence? And the answer is it could be, but you don't know yet. Remember, this is an active move, right? So we're actually in the throes of this uptrend. If we would sell off at the beginning of next week and confirm this as a higher high on lower momentum, that's when you could call it a bearish divergence. At this point, it's still an uptrend with momentum so far improving in the short term. Some of these breadth indicators, as you know, are not updated yet for Friday's close, but as of Thursday's close, you still have this very clear divergence with most of the cumulative advanced decline lines and the S&P 500 on a price basis, especially with mid caps, with small caps, and most importantly, with the New York Stock Exchange common stock only, which is on the top. Look at how this has remained above its 50-day moving average this whole time, rolling below it, making a new swing low after making a lower high. So the S&P is going higher. Most of these breadth indicators are negative, are actually going lower. What that tells you is underneath the hood, the market is not as strong as the S&P index itself would make it appear. The fact that the S&P advanced decline line is still holding up shows you that when in the large cap space, things are good. And at the end of today's show, one of the 3 and 3 is a beautiful chart that I think tells the story of the last 3 months and what I would call the stealth correction that we've actually been in this whole time. So what this tells you is, depending on what your portfolio looks like, you could actually be feeling a good amount of pain here. And I think there's opportunity to manage that risk if you focus on where the breakdowns are happening. We are still seeing a decent number of new highs, not a dramatic, healthy number that you would like to see in a strong uptrend. Now, this is not updated for Friday yet. We'll see if we get, as the S&P itself making a new 52-week highs, if we see a lot of stocks, things like Facebook and others are certainly able to do that. So I would assume that ticks higher a pretty good amount. We'll have to see. Notice the absence of new lows. And again, it's a little bit of a miss, because the 52-week low for most stocks is really far away. We'd have to have a dramatic sell-off on most charts to trigger a 52-week low. Looking at something like 1 month lows might be a better indication of when that uptrend is over. As of as of Thursday's close, it's worth noting that still only 47% of the S&P 500 members are above their 50-day moving average. Again, these breadth measures tell you that the average stocks are still not a big part of this uptrend. It's large cap that are leading it, and it's a relative small number. It's not overwhelmingly positive. The last thing I just wanted to leave you with, because we did talk about sentiment yesterday, so I don't want to beat that too much, but I just wanted to get a chart of small caps. I think the last piece of this puzzle is the underperformance of small caps. If you start the clock in March, small caps, with the exception of a couple weeks there in May into early June, small caps have been underperforming until proven otherwise. This tells you, these ratio charts will tell you to stay away from small caps and be leaning into large caps, to stay away from value and to be leaning into growth. Those trends are persisting. They are continuing even with the choppiness that we've seen this week. And I would assume that those trends are in place until proven otherwise. We need to take a quick commercial break. We'll be back with our next segment, the Final Bar Mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. Thank you so much for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts, using the power of data visualization to better understand the market environment. Two quick announcements before we get to our mailbag segment. Number one, I wanted to remind you, we are here to answer your questions. The mailbag that we'll be getting to momentarily is driven by questions from viewers like yourself. We would love to hear from you, particularly things you're running into as you're analyzing your own charts. What indicators are giving you trouble? What charts in particular are causing you to take a second look? What are you reading or seeing elsewhere that we can help clarify for you? Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Just put a comment below the video you're watching on our Stock Charts channel. We'll gather all those questions. We'll do another mailbag segment on Tuesday's show of next week, and we'd love to answer your question on the air. Finally, go to stockchartstv.com, use your email address, set up a free account. You can start watching all of our fantastic content. Our great guests this week, I was super happy with Ari Wall from Oppenheimer, Jonathan Krinsky from Baycrest Partners, Dale Pinkert from Forex Analytics did such a great job trying to put this week into proper context. All of that and more is available from our website. Also on your mobile device, just go to any of the app stores and search for Stock Charts TV on demand. Our next segment is called the Final Bar Mailbag. This is a chance to hear from you, answer your questions. And again, send us them to us anytime via email, thefinalbar@stockcharts.com. Question number one, is the Bullish Percent Index, $BPSPX, is that 50 level for the Bullish Percent Index a, quote, line in the sand, like the 50-day moving average is for the S&P 500? And I love how you actually mentioned the line in the sand. Clearly, I say that many times on the show, and I know it. I think that is such a basic concept. And it's so funny. One of the classic behavioral biases is called the endowment bias or the endowment effect. And what that means is something that you own, you develop an emotional attachment to it. And when it starts hurting you, when the price goes against you, you treat the stock in your portfolio, the ETF, you treat that position like something that you're emotionally attached to, and you're hesitant to take action even when the price or the conditions dictate it. And so by defining a line in the sand, a level at which you agree you are going to sell the position, sell a partial position, at the very least revisit your thinking, is super, super important. I encourage my own clients to define line in the sands clearly, or lines in the sand, every time you take on a new position. So your question is this 50 level a line in the sand? And the answer is, yes and no. I don't see sentiment indicators, breadth indicators like this necessarily as having a particular level. For me, they're much more descriptive about the overall environment. Having said that, on the chart of the Bullish Percent Index, as I usually show it, I have 3 lines in here: red, blue, and green. The red is at 70, the blue is at 50, the green is at 30. And this follows the general methodology with which it's advised you use the Bullish Percent indexes. When the bull market is in a good strong position, when most stocks are in a bullish signal according to their point and figure charts, the Bullish Percent Index will be above 70, which means at least 7 out of 10 of that universe, the stocks are in a buy signal right now. That's what we saw April, May, early June. When it breaks below 70, that's what's called a bear alert, which is saying that we're starting to show deterioration from some of the names that are part of that group. And as a result, it's telling you to exercise caution and look for potential breakdowns in price. Breaking below 50%, if I remember right, it's called a bear confirmed. That tells you we are now in a confirmed downtrend. And I may have been fudging the labels just there. That's, I think, what I remember there. There's a StockCharts chart school article on the Bullish Percent indexes. And if what I just said made no sense, go to the chart school link at the top of StockCharts, search for Bullish Percent. We have a really well done article which explains a lot more about the methodology and why 70, 50, and 30% are really good ones to do. To be honest with you, this is intended to be looked at on a point and figure chart on its own. Just for simplicity, I tend to look at it in a bar chart form because I'm so used to looking at a bar chart of the S&P. It just allows me to compare it along with a lot of other breadth indicators as part of my process. But you can look at it in point and figure form, and I'd encourage you to do that for sure. So 50% does confirm we're in a negative trend. You can see in this recent uptrend of the last year and a half, breaking below 50% happened in the February, March 2020 period. That has happened during major corrections as well. But a lot of times, other than that, breaking below 50% has actually been the short-term pullback, the weaker part of those tactical pullbacks before a resumption of the uptrend. So an important level to watch. Question number 2, I've been learning about technical analysis for some time, but don't know which techniques I should have more confidence in. What technical analysis techniques do you have statistical confidence in? That is such a fantastic question. And boy, I could give such a long-winded philosophical answer. I will try to keep it brief in the interest of the 30 minutes we have together every weekday for this show. So I would say there are 2 main ways you can think about technical analysis, right? One is the more qualitative way. The second is the more quantitative way. I was asked earlier, by the way, I posted something on social media and someone wrote back, have you back tested that? Because I have this other model that I've created that I've back tested that's incredible and it always works, et cetera, et cetera. And, my answer to them is that, I've never seen a back test I don't like, right? I mean, there are plenty of things you can do to test what would have worked under certain scenarios. And there are things you can do to try to make that more effective. So they have what's called a walk forward analysis or Monte Carlo testing, where you do out of sample testing and you develop a model during a certain period and then you test it outside of that period and you look for it. But again, at the end of the day, any model is not reality. You are making basic assumptions about what tomorrow is going to look like. So a back test could be great, but again, you are making some very specific assumptions about what tomorrow and beyond are going to look like, and that it will be similar conditions that it's going to allow your model to do well. A lot of times, things that backtest very good don't actually apply well in real life, and it's a lot of things like slippage or commissions or things that you may not have been appropriately able to model or modeling very well. The conditions just might be different, and we've seen plenty of examples where things backtest very well, you put money behind it, and all of a sudden it just starts not working all of a sudden. There's so many reasons why things like that can happen. So so if you're more of a qualitative analyst, which I am, some of my fellow CMTs are very model driven. I remember talking with Fred Schutzman in New York, who's one of the first technical analysts in the New York area that I met, talking with him about models. He's worked for hedge funds where he's developing, trading models based purely on charts. David Aronson, who wrote a book on evidence-based technical analysis and swears by we should be using statistical measures for everything. But I come from a very different community, which looks at charts as a way to describe investor behavior and describe investor psychology. So what do I use? The answer is anything that I showed you are things that I have found in my career working with institutional money managers and financial advisors that it works. Anything that has not worked for me are not things that I show you. And I guarantee you, things that I show you, that especially that I use regularly, are things that I found in my own process add value to understanding the market environment. And if you look at the basic chart that I have of a stock, and particularly the price, moving averages, the RSI, and the relative strength, out of everything I've ever used, those are by far the most meaningful things I have used to understand price behavior, to be on the right side of trends, to understand momentum, and to focus on what's working and get away from what's not. So that is the best I can tell you. And again, from when you work at a money management shop, your back test is you put stocks in a fund, and if the fund works, then you've tested it effectively and it works. And the things that I'm showing you are the things that I found to work over my career. One last question. Most of the stock experts in recent days have said investors should not create new positions and perhaps raise cash for the next 2 months. What should the ordinary investor do? It's a really thoughtful question. And even this week, you had people like Ari Wald talking about the short-term deterioration, but long-term, the trends are still strong. Compare that to like Jonathan Krinsky yesterday, who was actually very constructive and saying this is a market that should be bought. This is a strong uptrend with continued upside, and looking at breadth thrusts and other things. So, as a group of peers looking at charts, we are not 100% in agreement at any point. But your point is well taken. What do you do? And I would say it's very difficult for me on a show like this to make a specific recommendation, which I would certainly never do, because it's all about your particular conditions, your particular situation, and the decisions you make in your portfolio have to do with you answering that very important question, which is, what is the goal here? Am I trying to retire 30 years from now? Am I tactically managing an asset allocation discipline in the short term, or somewhere in between? Am I day trading? Am I a long-term position trader? Am I a longer-term investor, multi-year time horizon? And your answer to all of those questions would I hope help inform how you do it. At the end of the day, best we can do are highlight charts that are on the move, highlight charts that are on inflection points, what you actually do to make a portfolio that benefits from that. A lot of it, I think, is the game of money management. And it's so funny. I've often told people the technical analysis part is often the easy part. I can teach you how to look at charts and understand the discipline. What you actually do with it, following what the charts say, having a good money management plan, having good routines and decision-making processes, that is the real game, ladies and gentlemen. Let's continue on, wrap the show with a 3 and 3, 3 charts in 3 minutes. Here we go. Chart number 1 is a really fun chart that I sent around to clients earlier today, and I wanted to share with you. Basically, if you start the clock 3 months before today, and you look at the performance of the 9 major style and cap tier indexes, so large cap, mid cap, small cap, growth, core, and value, all of those 9 combinations, and then I put micro cap in here as well. 3 of those are by far the strong performers. Large cap growth up 11%. Large cap core, which is just the S&P 500, up 7.1%. Large cap value even up 2.8%. Micro caps are literally right at 0, and everything else is down. So basically, besides those 3 large cap Morningstar style boxes, all the other ones and micro caps are basically flat to down for the last 3 months. So when I talk about a stealth correction, when I talk about a market that does not feel as good as the indexes would tell you, this is the chart that I think tells that story. This is a relative, this is a subset of the market. Now, granted, a very large and weighty subset by market cap doing well, which is why the S&P is making new highs today. But everything else is actually down for the last 3 months. We're not making new highs month to month. We're actually making new lows this week. So, over that time period. So it is worth noting that there are the haves and the have-nots absolutely right now. Chart number 2 is just looking at advancers, decliners. I'm going to refresh the chart here very quickly. It looks like, and this is not based on volume, but just based on price, you have the advancers 63%, which is far below a blowout update. So even though the market's going higher, a lot of stocks, 1 in 3 in the New York Stock Exchange, actually closed lower. Finally, China really feeling the pain right now. When you ask me for charts to avoid, charts like the FXI, the MCHI, remind me of others like gaming stocks that are just in downtrends. Lower highs, lower lows, new relative lows are not charts to be looked for. Folks, that is our show for today. Thank you so much for joining us every day this week for the final bar. Have a great rest of your weekend. We'll see you Monday. Thanks again.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.